Another issue we have with the market is the unemployment rate. Unemployment rate is about 9.6% now, the highest, besides for some point in the 80s here, since 1948. And 9.6% doesn't even include all the people who've given up looking for work, all the people who've left the labor force. This number could easily be around 15, 16%. So that's another issue we have with the market. A big issue that we have, that's the biggest issue since the 50s, since after World War II, is the federal debt as percent of GDP. So right now our debt is 53% of our economy, or of our GDP. And this is the highest since the 50s. And unless our government learns how to deal with its debt issues, we might be in even more trouble. Again, a very important level in our market right now in the S&P is the 1130 level. We keep bouncing off it, and this is just a level to watch, because unless we can sustain, unless we can break this level and stay above it for a while, this is going to be a nice resistance level. This again is the head and shoulders that we have right now. We have a shoulder. Now this could be the shoulder, or we could break above this, and the ultimate shoulder top could be at around 11,000. So I'm watching that level. If we break above this, maybe it's a failure of the head and shoulders. If it breaks below 9,700 or around there, that confirms head and shoulders. Time to get out of the market. Now, these are the reasons that we've discussed for the market maybe going down. The Fed Chairman Ben Bernanke called this the unusual uncertainty, where we're really uncertain of what's going to happen in the economy, which is a very bad sign to be hearing from someone who's managing our country's economy. Again, based on technicals, we have the head and shoulders possibility. That's just like a comparison to the Great Depression. We have broadening tops, which are another our top formation that could drop us back down. We had the failure at the weekly 200-day moving average, which was the red line, which unless we break through that, we're going to have some issues as well. And we have the question of whether this is the dead cat bounce, which tricks us into thinking that the market's coming back, but just it would just take us back into the Great Recession. We have the weak consumer based on consumer confidence, which shows us that if the consumer is weak and is not happy with the economy, is not spending, that does not help our economy, it doesn't help us recover. We have weak housing and potential for a drop from there. We have the super cycle top with the Elliott waves, which shows us we're near the top and we could go into correction. We have really bad unemployment. We have the European problems. Now these are the long-term market indicators that we looked at. We had the S&P PE ratio, the dividend yield, market cap percent of nominal GDP, and the mutual fund cash. All these showed us that the market is not, by no means undervalued, is maybe close to fair value, but not undervalued, and we could have potential issues with this. We could have a nice correction. We have the question of inflation or deflation. We have low GDP growth. The economy is growing at a very slow rate, which could show us that we're going into deflation. We have the low CPI growth, which consumer price index, which shows us how fast things we spend money on, how much that costs and how fast that's growing. Since it's growing slow, we have deflation potentially. We have weak manufacturing, which is not helping the situation. And we also have regulation and debt issues. We had the flash crash in May that showed us how vulnerable the market is. We have a need for regulation in the derivatives and automated trading. Everything with subprime mortgages and all the issues we've had with the market have to do with derivatives and options and a lot of shady business that's going around in finance right now. We have the huge U.S. debt that has to be dealt with also. So all these point to a very tough market coming up. On the positive side, we have a couple of things that show us maybe we could go up. So some people have called this the pessimism bubble. What this means is if everyone's pessimistic and nobody thinks the market's going up, that's actually a good time to get in. So based on technicals, we have the market above the 200-day moving average, at least in the daily chart. So that's a good sign. We could have a potential failed head and shoulders like we showed in 1974, 1975, which takes us into a nice big bull market. Again, we have some stabilization. The banks have stabilized to a certain extent. unemployment is not getting too much worse. Housing looks like it's kind of stabilizing, and GDP growth is at least not negative anymore. We're growing, but at a slow rate. Also, we could say that there's cash ready to be spent. Funds might have some more cash. Companies and mergers and acquisitions could give a boost to the market. And the common investor that's been sitting on the sideline, if the market starts proving itself, maybe they'll jump in. And also, we could say that stocks are cheap relative to fixed income. Fixed income like bonds have done so well in the past 20 years. And we still have stocks that are paying better dividends than the bonds. So these are good things for the market. Another dangerous thing I noticed in the market is if you look at the S&P from 1997 to 2010, what we have here is a double top. A double top is also top formation. You have basically what you had is the S&P jumped up in 2000 all the way to 1550. Then we had the recession. We dropped back down here to 750, and then we went into another bull market until the top in 1550. So if you draw a line on top, they connect on top. So this is the resistance. The S&P had trouble breaking above the 1550 line. And what happened also is on the way back down, it had trouble breaking through this bottom line down here. So what we have is basically two hills or two mountains. They meet at the same place on the ground, and they have trouble beating each other at the top. So price is expected to bounce off the top here, and it's expected to bounce off the bottom. But if we approach this bottom line down here and we go through it, we could drop a lot more. What I drew here also is something called Fibonacci retracements. What those are is based on mathematical formulas. Price behaves in a certain way that from the bottom it moves up a certain from the bottom the price moves up to a certain place, and then it retraces, or it drops back down a certain percentage. Those percentages are 61.8, 62% basically, 50%, and 38%. So right here I drew a Fibonacci from the bottom of the market, from the recession, to the top. So what happened is the market dropped 100% of the move, and then after this 100% move, it's expected to bounce in Fibonacci numbers. So right here the market moved and it bounced back up right to the 62%. And right at that 62% level, it dropped back down. So this was the resistance right here. It dropped back 100%, it retraced 62% of the move, and from here it's expected to continue its move. So that's another dangerous sign. And if we look, this is a closer picture of what those Fibonacci's are. Again, from the top to the bottom, we retraced it. It moved 62% from, this is a 100% move, this is 62% retracement. It bounced off of it, and now it's bouncing off the 38% retracement in a shorter time span. So these are all basically retracement moves that show us that price is expected to bounce off those levels, but this could be the ultimate top before we drop back down. More Fibonacci numbers. Now this is our market from the top, 1550, to the bottom. Now what you could have done is, just like we have the head and shoulders up here, we had the head and shoulders at the bottom of the market also. And the way to measure, what happens is, if this is an inverse head and shoulders, when the price breaks, this is a shoulder, head, shoulder. When the price broke through the head and shoulders pattern to the upside in this case, it was that's what started the nice bull market. So you can even measure the point, the distance to which this moves. So this is the head and shoulders. The bottom was 666. The neckline over here was 950. You take the difference between the top over here and the neckline, that's 284. Once price breaks through this, you add 284 to the breakout point, which is 284 plus 950, and this tells you exactly where the target is to the ultimate top, which is, or at least the initial top, which is 1234. If you measured that out, you would have known that the top was going to reach right here. You would have sold your stock right around here. So this is our resistance line right here, and we bounced off it and formed a new head and shoulders. Now, if we form this head and shoulders and we break to the downside, we're going to drop by that much, at least. So those are just things I'm watching now. I'm watching to see whether we break through this 1200 level, whether we break through this 200-day moving average, or whether we break through this head and shoulders to the bottom. A lot of negative things about the market show us we could be dropping down like the Great Depression, but there is some positive news that could help us and shoot us back into a bull market like 1975.